You know, with homes sitting a little bit longer on the market, and let me put some perspective behind that though. Sitting long time on the market is 2 weeks and people are freaking out, right? We're coming out of a really crazy market. Okay.
Right.
So we went from days on market, 2 days, 30 offers, to now things are sitting for 2 weeks, maybe even 3 weeks. Historically speaking, that's not a long time, right?
Yeah, normal.
So now, you know, we have a lot of sellers are riding the tail end of that COVID, what do we want to call it? The COVID, it's like a COVID party train basically for homeowners, right?
Oh God, yeah.
For sellers. I mean, you're just nuts. So they're riding the tail end of that train, and they're wanting to sell for $300,000 over what it's probably worth. And now our market is trying to find where is that true market value,
Right.
which it still is. But with that, you have price reductions. You see more and more of those in the market. But you have people getting more and more creative. And really what it is a lot of this is just tricks of the trade from way back when that maybe have not even ever gone away entirely, but never felt the need to use, right? So the most common one right now is the seller buy down. We have two different kinds of options where the buyer can use seller credits to buy down their interest rate. So the two types of buy downs are temporary buy downs and permanent buy downs. Permanent is what I think most people think of when you think point buy down. So what is a point when you're looking at an interest rate and someone says, okay, your interest rate's 6.5% with 1 point. It's a fee that you pay as a buyer one time at closing to get the interest rate that you're getting. So everyone has interest rate options. Everyone also has their own interest rate. It's tailored to them, your credit score, the property type, your loan to value, how much you're putting down, all of that. And then you get a number. And you'll say, okay, today your choices are you can do a 6.5 with 1 point, or if you want to buy the rate down further, you can take 6.25 and pay 1.5 points. Or you could take a 7% and pay no points, right? So all of these are options that your loan officer should be giving you once you get to a point where you can actually lock in your interest rate. 1 point is calculated as 1% of your loan amount. So if you have a $100,000 loan amount, maybe we shouldn't use that number. Is that easier? I mean, it's just not realistic in Hawaii.
Right.
For
simplicity.
Yes, for easy math sakes, it's, for a $100,000 loan amount, 1 point's $1,000, 1%. You're paying $1,000. That's in addition to your normal closing costs that you have on a transaction, and that's the fee that you're paying for the rate that you're getting, right? So when you're in a situation where a seller is willing to give a seller credit, so with our home prices being what they are, it's not uncommon to see a $10,000, $15,000, $20,000 credit. Those are big numbers, but you can use the seller credits to buy down your interest rate. We can use some of it towards your interest rate buy down and then the rest of it towards paying your closing costs so that you're only out of pocket as your down payment. You cannot use seller credits for your down payment. I want to make that clear. So between the two, permanent's the most common. It's the most prevalent. It's been around for, most commonly used. So if you're getting $1,000 seller credit and you apply it towards your rate buy down, to buy it down to 6.5% interest, you get the 6.5% interest rate for 30 years, assuming you're getting a 30-year fixed mortgage, right?
Right.
If you have a $2,000 seller credit and you can buy the rate down to 2 points now, then you can buy it down to, I'm making this number up, to 5.5%, right?
Right.
So more points, lower rate. Well, the pro is that it's the lower rate for the life of the loan. The con is whatever seller credits you apply to the loan points, you don't ever get it back in the sense that if you sell the house, you refinance the loan,
right.
you get rid of the loan somehow, you don't get that back. Your benefit is that you get a lower payment every month for as long as you have that loan. Right? Make sense?
Makes sense.
Okay. Temporary buy down, and there's a 1-1 buy down, 2-1 buy down, 3-1 buy down. Okay, so just like the numbers go, a 1-1 would be a 1% lower interest rate in year one. And then in year two, going forward for the rest of your 29 years and your 30-year fixed mortgage, you're getting, you're back up to whatever your qualifying rate was. The 2-1 buy down is year one, you're 1%, 2% less on the interest rate. Year two, you're 1% less. And year three, you're at your qualifying rate through the end of your 30-year term. So just and the 3-1, so on and so forth, right? So just to put some numbers behind it, if your qualifying rate today was 6%, and you decided to use your seller credit towards the buy down, the temporary buy down, then your year 1, you're going to be at 4%. Year 2, you're going to be at 5%. And year 3, and for the rest of the life of the loan, you'll be back at the 6%. Okay. So obvious benefits of that is a lower short-term payment. This product is attractive for a lot of people, but the ones that kind of come to mind are people who have like an imminent career change coming up where they're going to get a promotion, or they have bonuses that they know of that they're going to be getting where it's added income for them. They have an inheritance. It could be something as simple as, I want to save money so that I can buy furniture for the house, right? Like it's the bottom line is you're going to get a short-term, temporary lower payment.
Right.
You still have to qualify on that 6%. Whatever your starting rate is, you still have to qualify on that. So with the permanent buy down, you could technically qualify for more by buying the rate down permanently, because they know that your payment is permanently going to be that lower payment. Okay. But for the temporary, you're still qualifying on the highest rate. Temporary buy down cannot be paid for by the buyer, whereas permanent buy downs, the buyer's funds can be used for the permanent buy down.
Oh, okay.
With the market cooling down a little bit, we have sellers who are more willing to reduce their price on their property. Could be because it's overpriced, lack of interest, whatever it is, right?
Right.
So in order to revive the listing and keep people interested, they're going to reduce the price by $20,000. As a buyer, it's more beneficial for you to take that $20,000 and apply it towards a rate buy down. Your monthly payment is going to be lower by buying down putting the $20,000 towards the buy down than it is for taking a $20,000 less on the purchase price, because that's amortized over 30 years. So your actual monthly savings ends up being less than if you use that same amount towards the rate buy down.
So does the 20 come from the seller's proceeds at closing?
Yeah.
Okay.
Speaking from the seller's perspective, reducing the price does save them a little on the closing costs that they have to pay, right?
Right.
The taxes and all of that. But even when you factor those in, if your seller, for instance, was contemplating or entertaining a $40K reduction in price or a $50K reduction in price, ask your loan officer to make to do a comparison for your seller, right? It's actually beneficial for them too. A $50K reduction in purchase price and what that equates to for the buyer in a monthly payment savings, you could actually pitch to your seller and say, okay, instead of reducing the price by $50K, let's leave the price as is and let's issue a $25K credit to the buyers. There's going to be a number where that amount applied to the point savings, or the point buy down, I should say, and interest rate savings, ends up saving the buyer more on a monthly payment standpoint.
Oh, right. Okay.
And your seller is benefiting from a higher net proceed.
Right.
Instead of doing a $50K reduction, they're doing a $25K seller credit. Does that make sense?
Don't you have a worksheet on this or a PDF?
I do have a worksheet on it. We can post that too. We can put it in the link just as an example, so you guys can kind of see the differences from a seller standpoint and from a buyer standpoint of what the temporary buy down can do for you, and what the permanent buy down can do for you. It's a good negotiating tool for the seller and for the buyer.
Okay. And something that I just want to point out is that it's not always cookie cutter. So it's always important that, number one, the agent that you're working with understands that there's more than one way to, get lending on a property. Yeah. But also it's important that you have a lender that knows these little nuances, because not everybody does. And that's important when you're really trying to make the numbers work.